Thank you for watching another episode of Real Estate the Right Way with your host, Michael.Wright, residential realtor on Long Island, New York, delivering you the best educational content when it comes to residential real estate. If you find value in this content, please give me a like, subscribe, give me a comment, hit that bell, and share it with someone you know who's currently looking for a home or will be in the near future. Today we're talking about the mortgage process. So what have we done so far? We've defined our budget, we defined our home criteria, we defined the location, we went out, we looked for a house, we found one, and it's absolutely amazing. We submitted an offer. That offer and terms were agreeable to the seller. We did the home inspection, negotiated any repair requests if that's applicable. The attorneys then talked contract language. The seller's attorney drew up the contract, the buyer's attorney reviewed it, you went and signed it, provided your down payment on contract, seller signed it, boom, full contract. What's next step? Apply for the mortgage. Key step here, you actually don't have to decide which bank or mortgage broker you're using until this step. And a quick tangent here, contrary to popular belief, you can get pre-approved by multiple banks, multiple brokerages, without it significantly affecting your credit score. So a lot of people say every time you get a hard pull on your credit, your score goes down. And in most situations, that's true. However, it's not always true. So if you get pre-approved and then you get qualified to buy a motorcycle and then you go to a used car lot and you get pre-approved to finance a car and then you talk to a couple different credit cards and apply for those, and then you're like, oh geez, I'm probably going to need a mattress too, so you go to a mattress store and you finance a mattress. Every one of those is going to be a hard pull on your credit because they're different categories. If you go to TD Bank, Bethpage Federal Credit Union, RCG Mortgage, and let's say Embrace Home Loans, and get pre-approved by all of them, well, guess what? Your credit is actually only going to be hit one time, because the people at the credit bureau, in the first situation with a house, a boat, a car, a motorcycle, credit card, mattress, they're going to say, holy cow, this person's ready to overextend themselves. We got to dial them back. We got to knock their score down a bit. This is getting pretty risky. When the credit bureaus see a credit report or credit pulls for pre-approval, 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 they don't assume that you're going to buy 5 houses. They assume you're buying 1 house. So that's one hit. Hope that clears it up. So, it's time to pick a bank or brokerage. There's advantages to each. I'm happy to have that conversation with you and recommend a couple if you'd like. However, whether you choose a bank or a brokerage, the process is somewhat similar in terms of the benchmarks that you need to hit. The first thing you'll do is fill out an application, which should be pretty similar to the application that you filled out for your pre-approval. If you didn't submit any documents and you didn't fill out an application for your pre-approval, I would question the individual that you're working with. But I digress. So, when you fill out your application, you should have all those documents handy because you've already submitted them for your pre-approval, and now it's just kind of a refresh of those docs. After you've filled out the application, the next thing you're going to do, or the bank is going to suggest, is that you order and pay for the appraisal. So the appraisal is the bank contacting the dispatcher that contacts the appraiser to go out and determine the value of the home so that the money that they're lending you, there's actually something behind it. Right? The house is worth what you want to pay or what you agreed to pay, and the money that the bank is lending, if something goes absolutely sideways, is protected by the value of the home. Buyer's biggest concern, and the seller's actually biggest concern as well with the appraisal, is what if it comes in low? Well, there's 4 things that can happen when an appraisal comes in low. If, let's say, a house, you agree to buy the house at $500,000, and the appraiser comes in and says the house is worth $475,000. What happens? Well, like I said, there's 4 ways forward. Actually, maybe 3 ways forward, 1 way back. The first way forward is the seller says, hey, listen, buyer, you agreed to pay $500,000 for my house. That's what I'm expecting you to pay. The appraiser, I don't know, maybe was having a bad day that day, and they said it's worth $475. You know it's worth $500. I know it's worth $500. I'm not accepting anything less than $500. Give me $500. And in that situation, you can come up with the $25,000 out of pocket, or sometimes you can restructure your loan a little bit to actually not come out with any more money out of pocket, and in some instances keep your monthly payment pretty similar. I'll do a separate video on that, but it's pretty cool how that math works. Okay, so that's the first scenario. The buyer comes out of pocket for the full difference. The second scenario is house appraises for, or purchase price is $500, house appraises for $475. Buyer says, listen, seller, I'm so sorry. Like, I don't, it's the appraiser, obviously. I don't have any more money out of pocket. I don't feel comfortable paying more than what the appraiser says the house is worth, even though that's one person's opinion. And if you get a house appraised by 3 appraisers, you're going to come up with 3 different numbers. I digress. The buyer is unwilling or unable to come out of pocket for the difference. So maybe in scenario number 2, the seller's in a bit of a bind. Maybe they're in contract for their next home, and they can actually come out of pocket for the difference. So the contract price gets adjusted from $500 down to $475. That's scenario number 2. Seller comes out of pocket. Scenario number 3, which is actually kind of the most common, is when the buyer and the seller agree to meet somewhere in the middle. It doesn't have to be exactly in the middle. It could be a little bit higher, a little bit lower. Depends on the buyer's situation financially and also the seller's situation. But they come together and they find a mutually agreeable path forward. What's the fourth scenario? Well, the fourth scenario is, unfortunately, we can't come to an agreement on how to move forward. And typically in this situation, the buyer gets their down payment back and the seller puts their house back on the market. So the buyer starts their home search again, the seller goes to look for another buyer. And that's the fourth scenario because it's really like I said, it's the way backwards. It's going backwards, and in most instances, it's not in anyone's best interest to do that. So more often than not, we find a way forward. So we found a way forward in the appraisal. Your application, neat and tidy, has been submitted to the underwriters by your loan officer or your mortgage broker. And actually, this is a kind of a good opportunity to explain why working with a trusted, experienced, and knowledgeable professional when it comes to the lending side is critical. So what happens is the loan officer or the loan broker, their job is to get you the loan. They send your file to the underwriter. The underwriter's job is to say, hey, bank, don't give these people the loan. They're not going to pay it back because I found this wrong, this is a risk, I'm not sure about this. A great loan officer or loan broker will answer those questions in the file before the underwriter asks them. An inexperienced loan officer will say, buyer, I need income, assets, credit report, boom, underwriter, here's the file, let me know what else you need. And in that instance, the underwriter is going to come back with a laundry list of items that ultimately show up on your mortgage commitment letter if you get to that point. So, however, if you're working with a qualified, professional, knowledgeable, experienced loan officer or loan broker, they're going to know what the underwriters typically ask for. And they're going to be able to provide that information in the original file so that when it gets sent to underwriting, maybe the underwriter says, okay, this file looks really great, here's your commitment, and on the commitment letter, there's some conditions that need to be achieved before you get your clear to close. The most common conditions that are on the mortgage commitment are homeowners insurance, title insurance, which will be on the next video, and typically like an employment verification, and if you have any large cash deposits, sometimes a letter of explanation is required for those as well. So, you've received your mortgage commitment. Once you clear the conditions on that commitment, you give a proof of those clearances to the loan officer. The loan officer gives your file back to the underwriter, and that goes into what's called final underwriting. So they take the last look. The bank takes the last look at your file, says, man, these people are good to go. We're so excited to lend them the money. Buyers, you got your clear to close. Fantastic. That's awesome. Clear to close means the attorneys, you, and the sellers can schedule the closing date. So that's key. The buyers, the sellers, both attorneys, plus the bank attorney, come together and schedule the closing date, time, and location once you get your clear to close. Before you get your clear to close, it's really difficult for attorneys to schedule the closing because they don't really know when it's going to occur, when you're going to get your clear to close. So in these scenarios, it can be stressful for buyers and for sellers, but that's why there's kind of an on or about period and kind of a mutually agreed upon within 30 days of the the closing on or about date, to give buyers and sellers the flexibility for the buyers to get their clear to close, the sellers to move, maybe get their clear to close on their next purchase, so everything kind of lines up. It does become a little bit last minute, but hopefully you're working with a trusted professional to make that process as smooth and easy as possible. Now, to get your clear to close, I mentioned earlier, you need homeowners insurance. And here's it's humorous from the outside. It's probably not humorous when you're inside of it. But let me give you a heads up so you're not scared about it when it happens to you. As you're clearing the conditions on the mortgage commitment letter, you're going to need to bind homeowners insurance. And you're going to call the homeowners insurance company, and the homeowners insurance company is going to say, when are you closing? And you're going to say, hey, attorney, or hey, bank, when are we closing? And they're going to say, well, we can't tell you that until you get homeowners insurance. You go back to the homeowners insurance company and say, we can't tell you that until you give me the policy. And they say, well, we can't give you the policy until we know when you're closing. Bit of a stalemate. So what ultimately happens is you tell the homeowners insurance company the date on before a couple days. Give them a date that you expect to close. You can bind the policy, give the policy to the bank, and then you'll get your clear to close and you'll schedule the closing date. And if you pay for insurance on a property that you don't own for a couple days, it's a little bit of a wasted money, but it's certainly worth it to get the house in the end. So don't be scared when the homeowners insurance company tells you we need the closing date before we can issue your policy, and the bank says we can't give you the closing date until you get your homeowners insurance policy. It sounds like one side doesn't know what the other side's doing, and this happens all the time. But you've cleared it, now you know how, you got your clear to close. The next step is getting your keys. So tune in to the next video where we go over title insurance, which is a big component to the mortgage commitment. And even if you're paying cash, title is a big thing. And I have a great example for you. So tune in then. Thank you so much for watching. As a reminder, give me a like, ask me a question in the comments, subscribe to the channel, ring that bell so you're always notified of new videos, and hey, tell me what home means to you, and I'll help you get there. Thanks so much.